All right, so in today's video, we're going to discuss partnerships. Partnerships are one of those things that you have to know as a student that's studying for your real estate licensing exam. But here's the thing to understand. As a real estate professional, you're going to deal with all different types of clients and customers. Yes, you're going to deal with the single person or the married couple, but you're also going to deal with partnerships. You're going to deal with corporations and limited liability companies, commonly known as LLCs. So you're going to deal with a variety of clients and customers. And so you have to know a little bit about them. So let's take a look at partnerships here. Now, a partnership is formed when two or more people or parties get together to create that partnership. And notice I said people or entities because Mike Smith and Tim Jones can get together and create a partnership. But so can 12th Street Incorporated and 11th Street Incorporated. So two corporations can get together and create a partnership as well. So it's people or entities. Now, partnerships can take on the name of their surnames or a trade name. So, I mean, think about certified public accountants and lawyers where you have Smith, and Jones. They're taking on the name of the partnership as names, or it can be 12th Street Real Estate, for example. And number three, there are two types of partnerships we're going to discuss in this video: general partnerships and limited partnerships. So let's take a look at each one of those in this video here. The first one I'm going to discuss is general partnerships. Now, under a general partnership, or sometimes called a GP, the individual partner, so let's say we have three partners that got together and created this general partnership. The individual partner, each one of those three are actively involved in the day-to-day operations of that company. They are actively involved in the decision-making, those type of things. Now, number two, as you see on your screen, the partner takes responsibility for the losses, the profits, and any debts that this partnership takes on. And one partner can bind the other to a bad decision. So let's look at number 6. It says consent of all partners is required to make a decision. So let's say that all three partners in this partnership, they agree that they're going to get a $500,000 line of credit, right? So they get it, they get the line of credit set up, and then general partner number 1 drains the account and takes off to Brazil. Now this general partnership is one minus that partner who took off to Brazil, but they also are now $500,000 in debt. The other two partners are now on the hook for the actions of partner number 1, who basically maxed out the line of credit. That's what is meant here. All right. So one partner can bind all the others to a decision that is made. Number 4, each partner is personally responsible for the debts incurred, and their personal assets are at risk. So that partner that took off to Brazil, leaving the other two with $500,000 in debt, well, those other two, their personal assets, their house, their vehicles, and things like that are at risk because of that debt. All right. Death terminates a partnership typically. And then number 7, partners are treated for tax purposes as active investors. We're not going to discuss in this video the difference between what's an active investor and what's a passive investor. That's a little deeper than you need to know, but just know what you have to know is general partnerships, for tax purposes, they're taxed as an active investor. The next type of partnership I want to discuss is what we call a limited partnership, or sometimes called an LP. Number 1, it involves a general or a managing partner and then 2 or more limited partners. So let's say 3 people get together to create this limited partnership. They're going to hire a general partner or a general manager. Now, the limited partnerships, the limited partners, they do not take an active role in the day-to-day operations and the day-to-day decision-making of that company, unlike the general partnership. That's why they hire this general manager to do that. So it is so critical in a limited partnership that they make the right hire and hire a good general manager. Limited partners are considered what we call passive investors. All right. And the general manager is paid to run the day-to-day operations. A death of one of the limited partners typically does not terminate the partnerships. And here's the benefit of an LP. They are only held liable for the amount of their investment into this partnership. Unlike the general partnership where they're held to all of the debts incurred with an LP, they're only held liable for the amount of their investment. They have limited liability should the partnership be sued. And there's no management obligation. And typically joint ventures are types of limited partnerships. So what's the difference, or what's the benefit of a limited partnership? Well, there's limited liability, and there's also that threshold on you are only responsible for the amount of your investment if the limited partnership fails. The downside is you have no control. The general partner controls all the day-to-day operations. So those are the differences between the limited partnerships and the general partnerships. Now hold on before you leave this video, because in this video to my right, I'm going to discuss the types of corporations which go hand in foot with this video, and you have to know them as well. So make sure you check out this video right here. Also, if you have not subscribed, click the little circle to my left. I would appreciate it. Comments or questions down below. That does it. I'll see you in my next video.